Samesh. It's been an absolute, wonderful July so far, so to speak. FIs have stopped selling, crude has reversed. Do you think markets have turned and we are in for a better second half versus a volatile and a crazy first half?
Yeah, good morning, Nikhil. So, yeah, I think for the first time we are seeing some positives now, okay, for the market. I mean, up till now it was all negatives which was there, and some cooling down of inflation, oil prices specifically coming down to around $100, and we've seen the large FIS selling, which we talked about, that has also kind of faded, at least for the time being, it looks like. But I think to that extent, I think we've seen some kind of a relief in the market in the last few days. And but I think going forward, I think one should still not forget that there is going to be some impact on growth, global growth specifically, and there will be some ramifications of that to few companies, especially some of the export orienters. And this quarterly numbers, while we've got some previews, okay, from the few companies in the banking sector or from the consumer uh, uh, on the consumer side, which has been kind of still okay, but one has to wait and see how much slowdown, okay, we're going to see in the coming quarters and what impact it will have on earnings and downgrades to earnings. So I think we'll get a better picture probably after this first quarter or probably the second quarter, where it will get more or less priced in. So I think markets have been in the fair zone. Okay, now that's what we've been saying. There is some risk to the market because of earnings downgrade. To that extent, there could be some downside in the markets going forward. But I think it will still be, at least for the next one quarter or so, I think it might still be a bit volatile. I don't think we are out of the woods as yet. But there is clearly some kind of hope coming up. And specifically, I think India looks a little better. I think if there is a mild global recession and commodities come down, because India is generally a large importer of commodities, okay, that should not be too bad for India context.
Okay. Mahesh, I would have thought that with a $20 crude decline, with a 50% decline in palm oil, with a 30% decline in wheat, market should have been doing cartwheels. That's not happening. How come that reaction, when crude went up, when commodity went up, everyone got worried. But that same happiness, that same joy, then same excitement is not coming when commodity prices are down.
So there are two reasons to that. One is, yeah, clearly commodity prices coming down. What is the reason for the commodity prices going down? One is, are the supply side issues getting addressed to some extent? But I think it is more led by demand, expectation of demand slowing down. So that is likely to impact growth, and that could impact the top line growth for a few sectors. And while there is a balancing impact because of reducing the commodity prices and margin improvement, but I think markets to large extent also look at how the growth is in the top line growth from a medium term perspective. So I think it is the fear of growth, I think, which is still kind of moderating down in kinds of upside, okay, what we like to see in some of these companies. And also the fact that, the valuations, like if you look at Indian markets in particular, we've not really seen such a big correction compared to what we've seen, global markets have seen. So to that extent, markets, I mean, while a lot of stocks have fallen quite a bit if you look at in the mid-cap and small-cap segment, but larger names, if you look at it, they had fallen, but not less. They were in the fair zone. So I think the reason for the market not to really, while commodity increases led to a correction and the fear about inflation and interest rates high, the fear about inflation peaking further is now kind of receding. To that extent, the rate hikes could be moderate, but I think growth is clearly likely to get impacted a bit. And that's the reason why the reaction is not as euphoric as one would have expected.
Mahesh, hi, morning. The last time we were talking, you were mentioning as to how you actually see the auto demand come back and the chip shortage likely to ease off. That's pretty much, along expected lines, and it's played out exactly same. In fact, all the commentary that we've heard from Tata Motors and many others seems to be indicating that the semiconductor chip shortage is not going to be such a big problem. In fact, the guidance has only been upped for the second half of the fiscal. Now that auto stocks as well have made a comeback, Mahesh, just wanted to understand where within autos does your preference lie?
Yeah, so autos have been, again, a combination of a easing in terms of the supply side constraints which were there. and the commodity prices coming off. So while the demand, I think now it's going to be more where the demand is strong, okay, which will drive the auto stocks higher. So if you look at within the whole basket, four-wheelers is where we see the demand to be slightly stronger. And two-wheelers is still recovering, but it's still not as strong as what one would expect over there, because rural demand is still kind of a bit weak. It could pick up in the second half if the agri output is good, and looking at the food prices where they are, okay, it could pick up, but still the demand there is slightly weak. And on commercial vehicles also, we're seeing a fairly good demand over there. So I would say that the preference, the strongest demand is in the four-wheelers, I think, which I think should do better. But again, on the balance, I would say the two-wheeler side, the valuations are still fairly attractive. However, there, because of the disruption coming in of electric vehicles and the competitive landscape kind of still unclear how it will shape out in the next 3 to 5 years, it could still be a bit tricky over there. I think companies which have got a strong product pipeline, new product, I think across the spectrum, I think companies which have got a good, strong product pipeline, I think we should be able to really gain market share. And those are the companies I think one should be looking at in the auto sector.
Mahesh, last we spoke, you were talking about as to how you're looking to buy stocks where correction has been significant. And it sure has been in the last month, month and a half. Where exactly have you added positions or been a buyer?
Yeah, so again,
You like buying?
the outlook essentially would be, I think, as I said earlier, some of the domestic-centric companies, discretionary names, okay, which had seen a good correction. One is also because of slowdown in demand, but also because of the commodity prices which had gone up, whether it's in consumer durables, whether it is in the building material space, or even in the consumer staple side, where we've seen good correction because of increasing the raw material prices, food price, feed prices, or palm oil prices. I think that's an area where, because these are long-term structural growth companies, and any correction because of short-term factors, I think is always a good opportunity to really add to these names. So those are the names where we have really looked at and built positions from a longer-term perspective.
Good morning. This is Nenta also joining in on the conversation. About a fortnight ago, when you were talking about how should you look at a portfolio at the moment, you were trending towards the large caps. Is that still the case?
Yeah, that's right. Yes. But I think if you look at now, if you look at the mid-cap space or the small-cap space, then almost 65% of the companies have seen a correction of more than 30%. That's the data what we saw last week. And there are pockets of opportunities emerging over there, though. In the short term, there could be more volatility over there, depending on how the growth impacts in some of these names, and also because of the flows. But I think slowly and steadily in this correction, I don't think we're still out of the woods. Okay, there could still be some volatility over the next quarter or so. And that would be a good time to really do stock picking in the mid-cap and small-cap space and build a portfolio over there. So as some of these concerns, okay, what we are looking at start to recede, I think the volatility or the fall in the mid-cap space, okay, what sharp fall what we saw, should get averted. And that could be a good time to really selectively start looking at the mid-cap and small-cap segment.
We're of course talking about at a time when there's so much volatility. As Nikunj was just asking you, market's still not doing cartwheels, even though crude is below $100 a barrel. The other thing to watch out for is, of course, the rupee flirting with 80 to the dollar. Having said that, then, what should one do with their portfolio? Is it going to be IT again? I'm asking you this a day ahead of the TCS results. Pharmaceuticals?
I think while the rupee has the dollar index we have seen has really broken out, right, has gone to around 106, and potentially could even go higher, and we could see further pressure on the rupee. But I think more important is to look at the top line drivers. If those are intact, I think then one can look at sectors. So the IT sector, whether it's the pharma sector, the key question is whether the top line growth in the coming years is getting impacted because of the global slowdown or not. If the answer is no, like IT sector, we are still not seeing much of an impact over there. So one can still look at it. In pharma sector, to that extent, should be fairly neutral to any kind of a slowdown. It should not get as much impacted. So yeah, so I think those are two sectors, okay, which can still be looked at to gain from the rupee depreciation. But again, it's not always straightforward looking at exporters, because if in a few sectors, if the growth for some of these companies is going to be adversely impacted, and that has a larger impact on the overall stock performance than the gains what one could get because of the rupee depreciation for most of the exporters.
Mahesh, now this year we've seen, last 1 year markets have given no returns broadly, plus minus 1% depending on the day you are looking at. Next 1 year, are we in for at least a double-digit return, maybe late teens?
I would believe so. Okay, and there are two reasons for that. One is that obviously post a correction, what we've seen in this year, the valuations are now reasonable. Okay, we are near the long-term average, and I would believe that for India, most of the companies, I think India's specific story, I think, is still fairly intact. While we are seeing some kind of a slowdown in this calendar year, but the structural drivers for India are fairly in place. And as I said, with a mild recession, assuming that there is a mild recession globally and not a full-blown recession, okay, that should not be too bad from India. We will see commodities and oil, other places coming off, which should be good. And I think from a fiscal side also, there have been some challenges, but I think there is still enough efforts taken by the government to really stimulate domestic growth. We are seeing revival after a long time, some green shoots on the capex side that should help to drive growth incrementally. Overall, if you look at the corporate balance sheet is also in fairly good state, so that should help. The banking sector, which is the large part of the index, is also looking fairly good in terms of earnings growth. We are not seeing any major challenges, okay, because of NPAs or corporate NPAs increasing, and that looks to be fairly stable. And overall credit growth also, which has been muted, is also now picking up. So all in all, if we put all this together, I don't see any big downgrade. I mean, there could be some downgrades to earnings, but I still see double-digit earnings growth. We still see double-digit earnings growth for companies over the next couple of years. If that is the case, then I don't see any reason why the market should not give double-digit returns the next calendar year. Assuming that this year is a bad year, or probably we are a tad negative from what we started.
Okay. Mahesh, you bought into metals, and that was more like a COVID comeback trade, a bombed out space. How should one approach metal stocks? A lot of analysts are telling us that, look, it's a good time to buy metal stocks because balance sheets are better, and these stocks will bottom out much ahead of where they bottomed out, let's say in 2020.
Yeah, so I think that's a fair argument, I would say, because the metal stocks or the commodity companies, especially the metal companies, the balance sheets are much better than what they were in the earlier cycle, right? Because last 2 years of supernormal profits has enabled these companies to significantly deleverage and bring down the debt levels. So overall, whether it is the debt equity ratio or debt to EBITDA has come down significantly. So that should clearly help to mitigate the impact in what we are seeing currently because of the sharp fall in the commodity prices. I think secondly is that, overall, I think in the commodity sector, the metal space, let us look at all the supplies coming in, and we're not seeing much supply capacities coming up. So clearly, currently, there is some amount of high inventory, which is there, which is getting liquidated. There is a problem in China, again, because of the shutdown, again, opening up. So that is creating some disruption. So I would say that if I take a slightly, I mean, near term, obviously there will be prices and you will see earnings getting downgraded. But I think a lot of that is priced in. So if you take a worst case scenario for most of the metal names, they would probably be near the price where one would expect. But I think the news flow would be slightly negative. But clearly, where there is value we see in this metal space, yes, I would say. And from a say next 2-3 year perspective, I think it should. I mean, once things stabilize, I think the stock should also do well. So I think that's the big difference. So that's the reason why we don't see those stocks coming back to the earlier cyclical lows what we've seen.
So Mahesh, what's your high conviction idea? If you say banks, it's more like a must-have. If you say auto, consensus is gathering towards auto. IT again, everybody owns it, everybody likes it. I want to understand that at this juncture, when markets are coming back, and we've seen a decent sell-off in mid and small cap stocks, what is that one high conviction idea of Mahesh Patil and of Birla AMC?
So I would say, I mean, I would not mention a particular sector, but as I said, domestic, okay, focused companies, okay, especially more, I would say the consumption led stock which are driven by consumption. I think those sectors should see a steady growth. I think we are not seeing a very roaring growth coming back, right, in the backdrop of what's happening globally. But companies, okay, India has been a consumption-driven economy. We saw rural economy getting impacted last year significantly, and we've seen a good correction in some of these stocks. I think we are betting on the fact that economy would, especially consumption, would come back slowly and steadily, especially rural consumption. And the factors, okay, which are driving for that would be assuming monsoons, okay, which was a bit delayed and now looking to be progressing well. Farm incomes, okay, should be better than what we've seen in the past, and even the government support as we move forward, okay, into the next week. The government will want to really support rural economy. So I think the rural theme, consumption theme, looks to be fairly strong and steady looking forward, where we see less risk over there. So I think that could be one strong theme to look forward over the next couple of years.
Right. Mahesh, great to have you on the show. Thank you so much for taking the time out and speaking with us today.